discuss pressing topics in fintech, regtech, covering regulatory, collateral, and digital across banking and insurance and finance. Welcome back to FinTalk, brought to you by Vermeer. Here we have been proud to deliver innovative software solutions in the industry with stability and cost efficiency for our global roster of clients. With over 20 years of trusted transformation in finance and insurance, we're bringing industry's top expertise to FinTalk. I'm Gerald Akhtar, and I'll be your host for this podcast. Welcome back to FinTalk, brought to you by Vermeer. I'm Gerald Akhtar, your host. We're going to continue the theme of Basel 3.1. Today I have Enrico Messori from Deloitte. Thank you for joining us, Enrico.
Thank you for having me.
So today's topic is market risk. So we've covered credit risk, now we're going to focus on market risk. There are changes. We know this is a CP.
It is a CP, but there are definitely big changes. So taking a step back, maybe, as you mentioned, it is a CP. It was published at the end of last year by the PRA through a consultation that closed in March. So now we are in that phase where the PRA is reviewing all the responses from the industry and will shortly, hopefully, finalize the regulation. What we are seeing is pretty much aligned, at least in general terms, to the original Basel proposal. And thankfully for many institutions, is also not too dissimilar for what has already been implemented for their European legal entities that went live with reporting in 2021.
So just to add to that, obviously going back onto the CP, there's some key changes that we've seen.
Yes.
Obviously rename to standardization. We've got the ASA that's come in and the IM. We're going to go through a load of jargons now. We're going to go through a load of acronyms again. You know, how much different is that from what people are doing now versus what does this new frame look like?
Well, in general terms, it is quite different in the sense that the objective of the regulators was to strengthen the market risk framework that had grown out of Basel 1 many decades ago now, and evolved through Basel 2.5, grown in a bit of organic way. And now the objective is to try and bring some order and structure into the framework, creating calculation and creating measures of capital that are more risk sensitive, so more closer to what the industry is doing from a management perspective, but is also increasing the level of complexity of the standardized calculations to make them as a credible fallback for internal models. And internal models themselves are becoming even more complex and even less able to cover a broad set of the portfolio. So if we look at the proposal, it's basically introducing or rebranding three calculations. You have the simplified standardized approach, which is very, very similar to the current standardized approach. So it's still a notional / modified duration based calculation with risk weights on a basis of a relatively simple grade. And this is applicable for small banks that don't tend to have large trading book positions. So it will be, I would say, relatively restricted in terms of applicability across the industry. The bulk of firms will be on what you mentioned is the ASA, or alternative standardized approach, which is the new baseline standardized approach. And this is a much more complex calculation. It is a standardized approach almost in name only, paraphrase, in the sense that it absorbs and incorporates many aspects of the current VaR calculations, in the sense that there are many more risk classes. The risk classes are treated at a much more granular level. So we have different data elements that are used to basically derive the risk weight for every single exposure. The exposure is no longer calculated at the notional or mark-to-market value, but we are using sensitivities. So it's a criteria that is a concept that is very familiar to the risk world. And finally, the aggregation of all risk factors is on the basis of regulatory prescribed correlations, which means that there's a limit to the capital benefit that comes from hedging of positions.
I had a quick look into the rules. That in the ASA method is regulator? Do you need regulatory permission for that?
There are certain elements where there's an optionality for which regulatory notification is required. So it's not a proper application as per the use of internal models, but for the use of optionality, there's certain level of documentation and evidence of the impact of the optionality on capital that needs to be presented. Examples are for the use of own sensitivities. So the regulation specifies how to calculate the sensitivities, but leaves the option to firms to use the current risk sensitivities that they use on their management and business processes currently. Another example is, is the decomposition of funds, for example. So there's around 10 elements in the regulation dotted across that for which firms have an opportunity to ask for this particular permission to use this methodology, which comes with a capital saving of some sort.
The ASA is targeted at kind of mid-tier firms, but it doesn't look that simple. It's supposed to be the advanced simple method, right? But it's not really that simple if you look at the rules side of it. Is that fair?
Not only targeted to mid-tier firms. It's like everything that we see in the Basel 3.1 framework. The standardized calculations now become the fallback and are used to calculate the output floor for the internal models, so the advanced calculations. So if we look at the new internal models under FRTB, you will see that it's a lot harder for firms to maintain the internal model permission. They will actually have to reapply across all portfolios. But effectively, a firm that today had maybe 80 or 90% of their market risk RWA coming from internal model calculation and the remaining 10% coming from standardized will find themselves in a position where under FRTB IMA, so under the internal model, they will be able to cover much less than 80 or 90% of their portfolio. And therefore, standardized calculation, the ASA, will represent a much more significant component of the RWA. So in general, almost everyone has to get ASA right.
Right, okay. That's something to look forward to and kind of get you to, because I've gone through the rules and it's a simple, but not simple. Do you just fall back to the standardized approach and say, you know what, forget everything else, let's just do the standard? It's similar to what we're doing now. Capital impact,
it is
probably similar.
It is what some of the tier one firms are thinking, right? Looking at the complexity of the internal models and looking at the complexity of the standardized, the trade-off in terms of like how much, given that you have to consider on the side the output floor as well, the benefit, the cost-benefit ratio of implementing an internal model and the complexity that come with it, not necessarily, or in many cases, does not outweigh the capital benefit. And therefore, many firms are saying ASA is complex enough and captures our business in a well enough articulated way.
Yeah, that's a good approach. I just want to target a couple of other things around market risk and the changes in Basel. CVA, to me, that's we've seen the draft templates as well. 13 templates now. It used to be one.
Yes,
calculation looks different as well. And and they're now starting to expand the scope as well. Before governments are included as well in the CVA calculation.
Yeah, CVA bridges that gap between the pure counterparty credit risk and the traditional market risk calculations. And therefore, as the counterparty credit risk calculation have already undergone an overhaul in 2020, and market risk, as we've discussed, is the subject of the current wave of change, CVA had to follow. And what we are seeing is that, yes, there's a significant increase in general across, not just across CVA, but even market risk, a significant increase in the number of disclosure templates that are proposed from a capital perspective. And this is partly because the regulator has now the ability, with this much more granular calculation and the significant increase in reference data that is required to drive this calculation, the regulator is basically saying, you are already using this data for the calculation, show it to me. Prove me the classification, give me the evidence and the detail of the underlying work of your calculation. Looking at the CVA framework, how it changes, again, good things come in three. So in this case as well, we have a breakdown of three possible methods for the capital calculation. Gone is the ACVA, that was the advanced methodology allowed for banks that already had an internal model for counterparty credit risk. And the old standardized calculation now becomes the BA-CVA, which is a sort of baseline calculation. BA stands for basic approach. And it's that sort of intermediate step between an SA-CCR, which is the new complex standardized calculation, which requires regulatory permission, has some relatively stringent criteria in terms of firm eligibility to use this treatment. And it's similar in calculation to the FRTB ASA. At the base of the CVA framework, it's instead a simplified approach in this case as well, which is only applicable under very specific conditions. The firm must not have hedging of CVA desk or hedging strategy. So it's specifically designed to capture those very limited exposures to certain counterparties. But as you say, in general, the scope of the calculation is greatly expanded because now it covers sovereign, it covers non-financial counterparties, non-financial corporates, and it also covers pension funds.
Yeah, there's the three new categories that have come in, isn't there? Is there a feeling there's going to be a significant increase in the CVA capital charges, obviously with an increase of?
From what I'm seeing from the initial results that some of the firms are seeing from their implementation, there is an increase in capital. That's part of the objective of the regulator, frankly speaking. But again, the extent of this increase is partly correlated to the quality of the implementation and the ability of firms to source the right reference data. What we are seeing through the Basel 3.1 framework is the need for a lot more reference data at a lot more granular level than ever before. Certainly that what is the case today for firms. So one of the challenges from an implementation perspective for firms is sourcing this data.
I want to just hold you on that one, and then I'm going to come back to that data side of it. Lastly, SA-CCR. We know SA-CCR was only implemented 18 months ago. Are we going to expect changes there as well?
For SA-CCR, the changes are minimal, and again, are connected to the fact that the CVA framework has changed. The three are linked to each other: FRTB, SA-CCR, and CVA. So having included pension funds in the CVA framework, what the PRA is now saying is include pension funds into the SA-CCR calculation as well. But as part of the leeway or flexibility that now the PRA has being outside of the EBA framework, what they've opted to do is to reduce the alpha factor, which is part of the formula to calculate the counterparty credit risk requirement. And this value is being reduced by from 1.4 to 1. And that's expected to bring some benefit or reduce the charge from holding pension funds exposures. The catch is that for legacy exposures, the difference in capital arising from the reduction in alpha has to be held as additional capital to be phased out in a linear fashion over the next 5 years.
Okay, like a transition approach,
yes.
Isn't it? Yeah. Okay. You mentioned data. This is always going to be an issue, especially with new regulations coming in. Even just looking at CVA, there's an increase in scope. That means there's an increase in data requirements. Mm-hmm. The new, especially the ASA approach as well, which requires a lot more data. Are you seeing that in the industry, that there's more of a data grab and firms going to have to go and data farm?
Yeah. Yes. It's a data and technology issue. On the data point specifically, as you mentioned, there's a significant increase in the volume of reference data, for example, and counterparty information that is required at a very granular level. What we are seeing is there is still certain uncertainty between the various regions because, of course, the US haven't published their final rules. This is expected in short order, but certainly what we see is Europe and UK are one step ahead in terms of finalizing their rules. There is still some differences in terms of how the calculations consume data. And so what some firms are trying to do is to leverage some third-party providers to gain some sort of consistency between different regions for the same exposure. So we are seeing certainly some efforts in that direction, but within firms, there's anyway a renewed focus on sorting the data, sorting the quality of data that, as you say, has always been the Achilles heel of many firms.
Yeah. And lastly, I know you've been actively in the industry working. Your advice to firms if they were listening and trying to work out what to do next?
Well, a couple of things. The first one is have a plan for the implementation. The plan should consider the end-to-end. One element that is often overlooked in this calculation is in the implementation of this calculation is the operating model. These calculations all will create a greater dependency from finance, which is the department that usually owns the regulatory reporting, into risk. That is the department that historically has had a better grasp of these metrics. So plan for the end-to-end, understand the interconnectedness between the various calculations, and think about the operating model. And the other suggestion or the other advice is to take part into the industry exercise that exists. The EBA, for example, and from this year, the PRA as well, will run hypothetical portfolio exercises. These are good opportunities for firms to benchmark themselves against the rest of the industry and understand which areas need further investment and further effort.
Yeah, that's good. Some really good points there. Thank you for that, Enrico. And thank you for your time. It's been really beneficial. I know we've covered a lot today.
Thank you. Has been a really good chat.
And we look forward to seeing you. We're going to see you next at the Vermeg Future Fit annual conference on the 27th of September. So
looking forward to it.
We'll be covering a lot more in detail there as well. So thank you again.
Thank you.
Speak to you in September.
Thanks.
Thank you.